Are you trying to figure out, is the stock market overvalued, undervalued, or priced just about right? Today we look at the Buffett Indicator. If you've always wondered, what is that indicator, or maybe it's brand new to you, stay tuned. I have some answers for you. Before I start on this video, I want to remind you that I have a free workshop that is available to you by clicking on the link in the description box below this video. It's about 90 minutes long. I'm not trying to sell you anything. I'm just trying to offer you some insight and different ways that I think, and to help you possibly think in different ways yourself. The coverage includes a lot of different areas. Of course, I talk about the financial markets in general and a little bit about the stock market itself. I also cover sports. I'm a big fan of sports. Music. I've been playing music since I was very young. And I also talk about professional and personal relationships. The goal of this workshop is to help you to think in either new or different ways, as well as for you to get to know me and my style. Welcome back to the series on market valuation. This is currently part 4 of the series. In this video, we look at a thing called the Buffett Indicator in our trek to try to figure out what is the current market valuation of the stock market. We have a lot of different tools that we can use to determine, is the stock market overvalued, or we also call this expensive, undervalued, which means cheap, or fairly valued, which means just about right. The Goldilocks valuation approach, where things aren't too hot or too cold, they're just right. There is a very useful website that I use to get a lot of this information. Instead of trying to reinvent the wheel, what I've done is just gone piggyback onto a website that is very helpful. This is Current Market Valuation. Their web address is currentmarketvaluation.com. I check this site about once a week. They have a pretty good approach to market valuation. They don't just settle on 1 or 2 models. They take 4 different models together to reach a consensus. This video talks about the Buffett Indicator. You may have heard of Warren Buffett. He's probably the most famous investor, and a lot of people really try to piggyback what he does and the way that he picks stocks because he's been very successful. The Buffett Indicator is named after Warren Buffett, so that only stands to reason. The Buffett Indicator compares the value of the U.S. stock market to a thing called GDP, or Gross Domestic Product. This is the largest measurement of the U.S. economy. And if this number is going up, that means the economy is growing. If this number is going down, that means the economy is contracting or shrinking. What a lot of investors like to do is base the valuation of the stock market with GDP to see if this gives us any insight. Some people like this approach. Other people see a lot of shortcomings in this approach. As of August 26, 2021, currentmarketvaluation.com has calculated the Buffett Indicator as the aggregate U.S. market value of $54.8 trillion, so almost $55 trillion in stock market value. The annualized GDP, means year over year, is growing right now to reach a level of about $23 trillion. The Buffett Indicator takes the total value of the stock market and then divides it by the current GDP value, and that gives us a percentage of 238%. Woohoo! Well, what does that tell us? So looking at this from a valuation level, what does 238% mean? Is that high? Is it low? Or is it just about right? The historical average has been about 120%. And if you think about that, it makes sense. The stock market looks forward, and so current prices tend to be higher because we're looking at a positive future. If the stock market is looking at a negative future, prices would go down. But since in a capitalist society and in American society, at least for a while longer, we are positive about the future, so we anticipate that companies will grow, they will have expanded profits, their stock prices will go up, and so it is worth the risk to invest in these companies. But when does the party go on for too long? That's what we're trying to figure out here. 238% is 1.98 or almost 2 times higher than the historical average. Is that a reason for concern? Maybe yes, maybe no. We will look this over and see what we conclude. Here is a chart of the Buffett Indicator as published by Current Market Value. The composite market value, which is the total value of the stock market, compared to the gross domestic product or GDP. Looking at this chart as of August 26, 2021, we do have a rate of 238%, which is the ratio of the market value to GDP. Then they go on to say, because they calculate standard deviations of this, they say that is 90% higher than the long-term trend line. So we're almost double what historically prices have been. Also on this chart, we see the historical trend line, which is going up over a period of time. That's what you want to see in a good, healthy economy. The GDP is expanding. The valuations are expanding. People are willing to take a little more risk, and we're seeing growth. The exponential trend line, that's just how they calculate this. That's a method that is used for calculating moving averages. That's called an exponential moving average. And I have other videos where I talk about that. This suggests a market value to GDP ratio of 120% to be fairly valued. We can see on this chart we're way above that. So one of these things is going to have to change in order for this model to be friendly to the market environment. Either the exponential trend line is going to have to keep going up and go up by quite a bit, which is showing growth in the economy, or stock prices will need to come down. Does Warren Buffett actually have anything to do with this indicator? He's said to have called the Buffett Indicator the best single measure of where valuations stand at any given moment. There's a problem with that. He's kind of walked that back, as they say at currentmarketvalue.com. There's really no single great indicator. It would be nice if we could have one chart, one line, one thing to look at that tells us everything we need to know. That is just not the case. As hard as people work on this, and as much as people want this, we just have to look at lots of different things and put them together to reach our conclusions. So Buffett has since walked back these comments, hesitating to endorse any single measurement as either comprehensive or consistent over time. It may work during one period of time, but it may not work during a different period of time. Although history does have a tendency to repeat itself, not only in that way, but it also rhymes. There's nothing new under the sun. There are times when we're seeing things that we haven't seen before in the sense that they're lining up a little differently. And I'll explain that a little more here in just a moment. So looking at this indicator and nothing else and trying to reach a full-blown conclusion does not give you the whole picture. So how is the Buffett Indicator calculated? There are two pieces of data that we use to calculate this. There's the total market value, again, and I'll go through and explain what that means, as well as GDP, or gross domestic product. The index that I look at to get a view of the entire stock market, not just the S&P 500 or the Dow or the NASDAQ or the NASDAQ 100, I use a thing called the Wilshire 5000, and that is what currentmarketvaluation.com does as well. Although my focus is on the S&P 500, I do look at other markets just to see what's going on. The index that we can use to see all of the market together is the Wilshire 5000. And this is a chart updated as of the last day of August 2021. In my daily and weekly videos, I will mention this chart from time to time. This is just your standard vanilla bar chart here with volume going along the bottom. We can just look at this and go, ooh, ah, but then what we need to do is apply some studies on top of this to really give us more insight. What currentmarketvaluation.com has done is they've gone back not only to about 1970, which is when the Wilshire 5000 started, they've gone back even further, put these numbers together, and have been able to go all the way back to 1950 up to the present time. Over on the right-hand side, we can see where the stock market currently has a valuation of about $54.8 trillion, almost $55 trillion. This changes every day. If the market goes up, we add a little bit to that. If the market goes down, a little bit is taken away. But what we're looking at this for does not change all that often. So this is one of the longer term charts that we look at. Let's talk a minute about gross domestic product, or GDP. It's the largest measurement of the total production of the U.S. economy. And every developed country has a GDP. There's one for Germany, Japan, England, China. The U.S. also has a GDP, and it gives us the ability to compare the growth in one country with growth in another country, or we look at it just within the U.S. to see how is growth occurring over time. Are we higher than we were a year ago, a quarter ago, 10 years ago, or are we going down? The GDP numbers, the official numbers that come out, are released quarterly. So we get them 4 times a year, every 3 months. Now we do have the preliminary report that comes out 1 month, and then the updated preliminary final recommendation before the big number comes out. We have stuff that comes out about every month. And then after the GDP is released, then a month later, we get the revised GDP. So this number can really change, and it can go back in time. Back in about 2005, 2006, we thought, okay, we've been in a recession for about 3 quarters now. The federal government released GDP numbers only to show the market, no, we've been in a recession for about 6 or 8 months now. And that really freaked out the market, and it made a lot of people very angry because these numbers are changed as new information comes in and modifications are necessary. The GDP looks backward. The stock market doesn't look backward. It looks forward. So we can only use this information so much as far as the real information, the official numbers that were used to create the GDP. We have to look back to get that. Now comes the crystal ball time. In order to figure out what is GDP going to do in the future, now we have to look at forecasts. And forecasts are just wishful thinking, and they always change. Sometimes these numbers are pretty close to being correct, and other times they are way off. What current market valuation does is they update the GDP with forecast numbers that are released by the Atlanta Fed. The current forecast is for about 23 trillion. Again, we don't know, is that a big number, a small number? Well, we have to look at it in context. So here's the current GDP the current market valuation comes up with based on forecasts. And they're projecting it for the 3rd quarter of 2021. It's called the GDP Now estimate of 5.1% annualized growth. And that's a pretty healthy economy. If you're getting in the 5 to 6 range, that means that the economy is growing, but it's not too fast and it's not too slow. It's certainly a lot better than it was when the pandemic first started, when we hit into a recession. But since then, things have been modified and changed, and all of this stimulus, as well as monetary policy, has been very market-friendly and business-friendly, and that has allowed for companies to show positive GDP. The next chart shows the Buffett Indicator going back to 1950. And we also have some pretty little red, yellow, green, and light green lines. This is really the chart that we like to look at, or that I look at. Right about in the middle, we have the historical trend line, which means that's the fairly valued amount. We put that at 0. And what we want to do is look at the current valuation. Is it higher than the historical average or lower than the historical average? And just to give us some context, we go all the way back to 1950, where the yellow and the red line on the top are 1 and 2 standard deviations. That's how far away are we getting from the average. Down below, we also have the green and the dark green lines, which show us on the negative side how far are we getting away from the historical average. If you look all the way over to the right-hand side, you can see right now, we're going up almost off the chart. We're at 238% of the market value to GDP, which is 90% higher than the long-term trend line. Almost 100% higher, almost double. Looking throughout history, we can see, well, when were some other difficult times in the market? In the year 2000, when we had the internet bubble or the dot-com boom and bust, the Buffett Indicator was above 2 standard deviations, and that was considered to be very overvalued. After that, boom, we saw things go down. Then in 2007 into 2008, the Buffett Indicator wasn't really giving us many warning signs. When it did prove to be helpful, it was when we dropped all the way into 2008, into 2009, and we bottomed, and we were well below 1 standard deviation of 48% to the downside. We can't really look at this chart and say, oh, this is a top or this is a bottom. We can only look back because this number way over on the right-hand side, it may be high right now, but believe it or not, it can go even higher. We are in an extreme overvalued situation right now. To bring it a little closer to today, this is the same chart, but only going back to 1990. We have the standard deviations both above and below. We have the historical trend line right in the middle. It shows in the year 2000 how we had the internet bubble when prices were very overvalued, the bottom of the financial crisis, and then where we're at right now. So what are some of the shortcomings of the Buffett Indicator? It's not perfect, and Warren Buffett will be the first to admit that, even though he didn't create it. Because he came out when this indicator was first created and he said, oh, this is pretty good, it got his name stuck to it. And a lot of people looked to him for guidance and for wisdom about how to invest. And so having an indicator called the Buffett Indicator was kind of a cool thing, but it really doesn't have much to do with Warren Buffett himself. It's not a one-size-fits-all indicator. This indicator is just one indicator among many that we use to reach a consensus about what is happening and then what might happen in the future. Other markets, such as bonds, which means interest rates, are not considered in the context of the Buffett Indicator to the stock market. And I'll go through and explain that a little bit. Today, investors are buying stocks to get good returns since interest rates are so low. During other times, investors bought stocks for returns and not as an alternative to low interest rates. Okay, let me break that down a little bit. Going back to the year 2000, let's say you had $10,000 and you wanted to invest that. Well, you have a lot of choices. You can get into real estate, you can get into the stock market, you can get into the bond market. We really didn't have cryptocurrencies back then. You could put it in gold. You have a lot of choices. Well, think of it this way. In the year 2000, interest rates were doing pretty good. So you could stick your money into the bond market. And you were getting about 6 to 6.5%, which is pretty good, especially compared to today's rates. But you go to those parties or you hang out with your friends and they say, man, my internet stock doubled 3 times in the last year. And you're going, I'm just looking at a 6% return, and my buddy over here has a 300% return in his .com stock. I'm really starting to feel greedy. I'm really starting to feel maybe I should take my money out of bonds and put them into stocks. A lot of people did that. And then when they suddenly saw that there were no earnings behind these .com stocks, they started selling them, and internet stocks that were worth $300 per share were suddenly now worth 0. So now let's look at how things are now. You have $10,000 to invest. It's 2021. You're looking at the bond market going, my goodness, interest rates are at 0 and I can get maybe 1.5% on a 30-year bond. I might wait until it goes up to 2%. A 10-year bond, woo, that's getting me almost nothing. In fact, I'm losing money if I take into account inflation. I better take this money and put it into the stock market. I really don't have a choice right now. I can go with ultra-safe bonds, and yeah, that might be safe, but really, I'm losing money. So I need to take that money and put it into the stock market. There are millions of investors who are doing that, and they have billions of dollars where they're thinking, we can't really put this into the bond market right now. We better stick it over in the stock market. That's going up and up and up, and we're hitting all-time highs every other day. So what you have then is a fear and greed tug-of-war that's going on here. This will dictate what people do. Before, let's say in the year 2000, we had greed over necessity. You have to get a return. Necessity is the return. Do you want that return to come from the bond market or the stock market? Well, in the year 2000, you could get an okay return in the bond market, but you could get potentially a really good return in the stock market with all these .com stocks. So that's what happened before. Now, it's necessity over greed. You don't really have the bond market to choose from, so you have to get some kind of a good return on your money, so you put it into the stock market. Yeah, there's not a lot of dividends being paid right now, but we have stocks that are going up very nicely, and the market is going up overall and continues to be in a pretty strong uptrend. Now, there are a lot of doom and gloomers out there who are predicting, look at the Buffett Indicator, it's so overvalued right now, we're going to crash, you need to sell everything right now. You have other people saying, no, not necessarily. This could go on for a while longer. That's why we need to keep an eye on things and evaluate them on a daily, weekly, and monthly basis so that then we are not caught off guard. Here's a chart comparing the Buffett Indicator with Treasury bond rates. You have the historical Treasury rate at 6%. That's the dotted line going across the middle. In about the year 2000, we had the internet bubble peak with the market value to GDP during what we consider to be a normal interest rate environment. Interest rates at that time were about 6.5%. Stocks were very overvalued at that point. So what did people do? They took their money out of stocks and put them into bonds. That was seen as the better play. And after that, we saw the whole dot-com bust. Well, let's compare that with right now, way over on the right-hand side. Stock market is at all-time highs, and interest rates are at all-time lows. So if you want to take your money out of the stock market and put it into the bond market, that's not really a good alternative. You'll be losing money at that point. So people need to keep their money in the stock market. Or if they get more money that they want to invest, they're going to continue to put it in the stock market. This is one scenario for the stock market not necessarily crashing anytime soon or really changing trend. Now that could all change, but this is the conclusion that we can reach right now based on the Buffett Indicator and comparing it to interest rates. So what is the conclusion? The Buffett Indicator that's posted at currentmarketvaluation.com is strongly overvalued. But does that really matter? Not so much. There are other indicators that suggest that we're at fair value and other indicators that say that we are strongly overvalued. But as I've said before, an overvalued situation can go on for a long, long time. And some of the models and indicators that we use show that we've been overvalued since 2009. Other stock market valuation measurements show that the S&P 500 is also overvalued. We've known that for quite a while. You've probably seen that yourself, or you've read information about that, or you've watched some of the other videos in this series that have suggested that yes, we are in fact overvalued. But do we need to freak out right now? Not necessarily. These are longer term measures. You might read an article or come across somebody that posts a video saying, everything's gonna just fall apart. The end of the world is coming. You need to sell everything off right now. And if they're using this as the foundation for their justification, they're probably not doing you a real service. You can always find positive and negative things, no matter what is happening. We have the perma bull group that always thinks that things are going to be better and stay better. And then we have the perma bears who are always predicting doom and gloom. It's really difficult to put any faith in either one of those conclusions. So what do we do about that? We reach our own conclusions. However, it is necessary to have a plan developed and in place in case the market environment changes. Things are looking okay as I record this, but we don't know what's going to happen in the future. The important thing for right now is just to be aware of the current situation, realizing that it may not change overnight or it may continue for a lengthy period of time, and just have a plan in place. What am I going to do if? What am I going to do if the market continues in its uptrend and becomes even more overvalued than it is now? What am I going to do if the stock market stays about the same and really doesn't change? What am I going to do if the trend actually continues and starts to go down? This is the plan that you need to have in place and just sitting and waiting and ready to go if things change. Think of it as a backup system. If other measurement tools that we use to measure trend, if they suggest a major trend in change from up to down, implementing that plan will be imperative for you. Those who have only long positions, which means you buy low and sell high, you become more defensive at that point. Do you implement hedging by buying options to help hedge your investments and limit your losses? Do you get into other stocks that tend to perform better, if not well, in downtrends? These are questions that you need to answer. Or are you the kind of investor who does take advantage of short positions? These are positions that gain in value as prices decline. That's where you're being more offensive. you're taking advantage of the downtrend. You may not be doing that now because the market has been in an uptrend. Well, if we switch and start going down, will you take advantage of that? Most investors don't do that. You have to decide, is that something that you do want to do or that you don't want to do? The idea is to be ready and be prepared, and if you see things start to change, this plan that you've already developed and come up with starts to be implemented. So thank you very much for taking the time to watch this video. I really do appreciate that. If desired, please click the like or dislike. Please leave any comments below. Consider subscribing to this channel, which will help it grow and allow lots of other people to be able to see this video. Please access the free workshop that I talked about at the beginning of this video. I do have a public Facebook group where we talk about the stock market as a whole and the S&P 500. We don't discuss cryptos or gold or other markets in that discussion group. And I do have a blog at spxinvestingblog.com where I post articles which are pretty much mirror images of the videos. So with that being said, thank you very much, and I'll talk to you in the next video.